everyone. Welcome to another great webinar we have. I enjoy doing this one every year for giving some insight into health savings accounts. We will get started here in a few moments. I just want to give everyone a chance to trickle in. Keep in mind that, excuse me, if you are in attendance today, all of your audio has been muted. So if you would like to ask a question, I encourage you to do so. I'm happy to kind of dive into any type of sub context on anything that you would like to get some more information on. If you would like a copy of the slides, they are attached as a handout to this presentation, so make sure you grab those from there. And if you have questions, type them into the chat box. We will address those as they come up, and we'll get started here in a few minutes. Just bear with us. Thank you. A little bit about myself. My name is Alex Perny. I've been with Advanta IRA since 2012. If you do have any questions after this, my direct line is 727-754-9954, and my email is also up here as well, Perny, that's P as in Paul, E-R-N-Y, at advantaira.com. Little disclaimer here today, and it's especially true in making choices about your healthcare and potentially tax implications that come along with choosing these types of plans. Advanta IRA and our employees do not provide investment advice or endorse or promote any products. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. So, what is an HSA? This is something I like to spend a little bit of time on. I do have some slides that enumerate this a little bit better as well for people that like it kind of written out. But HSAs are a type of tax advantage savings account for individuals with high deductible healthcare plans. Now, I know everything seems like it has a very high deductible nowadays, and that certainly is true. But there is a certain metric and criteria that does well define what a high deductible healthcare plan is. And for the purpose of this presentation, I will be truncating that to HDHP. So if you hear me say HDHP, I'm referring to the type of plan that corresponds to having a HSA account. Now, additionally, there are a lot of things that look like an HSA, that walk like an HSA, but they are in fact not an HSA. I'm referring to FSAs and flex spending accounts and MRAs, medical reimbursement accounts. So there are several different types of accounts that are out there that all kind of look like a health savings account, and by kind of general definition are savings accounts for healthcare. Which again, this kind of leads to the large amount of confusion around these types of plans, whether it comes from the different types of kind of savings account plans that you might see from an employer or on the marketplace for the Affordable Care Act, or just in general looking at how expensive everything is and saying, hey, this is a high deductible healthcare plan, why doesn't an HSA qualify? So again, we will go through all of that, I promise you, in very clear detail here in a minute. But again, it's just something to always keep in the back of your mind, that just because you're looking at an HSA doesn't necessarily mean that your healthcare plan will qualify for it, or that you already maybe even have an HSA plan. All those things will kind of become clear when we go through this. But again, it's unfortunate that it is so confusing and convoluted, because healthcare in the United States, at least, is just that, confusing and convoluted. And when it comes to choosing the kind of healthcare plan and how you save and invest the funds for those types of medical expenses, nothing really starts to get any clearer. But hopefully we'll levy some clarity on it today for everyone. Again, I do encourage you to ask questions. I do my best to answer any and all of them that I am able to, and hopefully we can help other people on the call as well. A little bit of the history about these kind of accounts. And this is one of the few times that I do actually kind of give a little bit of a history lesson, because it's important to understand kind of where the genesis of some of these different types of accounts are and how we came to be with what we're at right now. So if we go all the way back into the Reagan administration back in 1984, we have the National Center for Policy Analysis kind of identifies the need for something to help taxpayers pay for medical expenses. And it just really wasn't kind of something that had been kind of in the ethos of our legislators up until that point. So fast forward 8 years to 1992, we start to get some type of traction for having some plans in place. And then 12 years after the initial kind of look at everything, we get the first stab at this, which was the Archer MSA. Some of you on this call today might actually remember these plans. They are, in my almost 13 years of doing retirement plan work, I've actually never come across one directly, but I know they're still out there. But basically, that was the first stab at being able to have some type of savings account that where the responsibility for healthcare savings was placed onto the taxpayer. But these were plans that were contributions were made by employers. They were subject to payroll and income tax, and the monies could not be rolled over year to year. So it was a use it or lose it. There were some adjustments later on to make these plans tax-free. Now, coming out of the 90s and into the early 2000s, we get the first thing that really kind of looks like an HSA, which was the health reimbursement account. These contributions can be rolled over year to year, but you lose those funds when you leave an employer. So that was kind of the big drawback to those. And HRAs are still in existence today. My wife had one for several years with an employer, and they work pretty well. But the problem is that if you ever leave your employer, your vested balance in that just goes away, and there's really kind of no way to recapture that. So while they do certainly offer a benefit to a lower deductible for a healthcare plan, a lower cost with a higher deductible with some additional flexible spending dollars, it is a user lose type plan. So HRAs are definitely still in existence. They can also be looked at flex spending accounts or FSAs. But the HRA, again, is a type of savings account, but it is directly tied to your employer, and you do lose those balances. So going back now 21 years, which is odd to think about, but in 2003, we get HSAs. And the big divergence from HSAs to health reimbursement accounts is that portability and a few other avenues to be able to use these funds in certain circumstances after a certain age for non-medical related expenses. HRAs are very tight with what you can use them for. There's no availability to use them for non-healthcare related expenses. HSAs, if you're under the age of 65, you can, if you're willing to pay a 20% penalty and potentially income tax, you can use them for whatever you would like to, not just medical expenses. So again, going back 21 years, we finally have HSAs coming into existence. So a little bit more information. Back in 2005 is when the Archer MSA expired. You still can use them, but if you do have money in them, you can't contribute to them. Now, the flexible spending account basically is the HRA kind of hybrid. Again, I'm not necessarily sure why they have a few different names for them. They delineate a little bit, but for the general purpose of this, the FSA, the flex spending account, along with the health reimbursement account, are more or less the same thing. You might look at an employer plan. Let's say you're married and one of you is going to be looking at the Affordable Care Act marketplace. You might see a FSA type plan, and then if your spouse is looking at their employer's offering, you might see it listed as an HRA plan or a health reimbursement account plan. Basically arose by any other name. But again, these are types of plans that cover expenses not paid insurance. You can use them for paying deductibles, co-pays, co-insurance. You can carry over $500 year to year now under the ACA. It offers employers alongside offered by employers along traditional healthcare plans. The maximum contribution, should have updated that, it's actually $3,300 per year for those types of plans. So for 2024, it's $3,300. Again, I have not seen anyone that has an employer that has a maximal contribution to these types of plans, but that is the maximum kind of contribution to an FSA or flex spending account. Again, not an HSA and not portable from job to job. So some benefits of an HSA account. These plans, as I'll illustrate here in a little bit, are extremely powerful when it comes to being able to create tax-deferred growth, tax-free distributions, and tax-deferred distributions as well. It kind of melds a lot of the similarities between Roth and traditional IRAs with some restrictions, but you have a lot of ability to really take a lot of more franchise in your own healthcare and your savings for that, as well as another great vehicle for investment opportunities with these types of plans. You're not just limited to IRAs, 401ks. You can invest and grow your health savings account and get some really great tax benefit from it as well. So the general basis for why these plans were created were to help to create better healthcare spending habits. The thought in general behind that is if you are having to spend more of your own money, you'll do more research on what you are purchasing, what services and care you are receiving to make better decisions. Now, I know that can be point that we could probably argue ad infinitum, but again, that's kind of the general thesis behind it. And certainly there's some truth to that. But with the cost of healthcare in general, it's maybe not as apparent of a point as when these things came out back in 2003. Again, theoretically, it'll lower healthcare costs. Again, we don't really see that in practice, but the fact that we have the framework for these accounts is, again, I believe, a net positive. They're a special type of savings account just for healthcare expenses, and they're designed to supplement your health insurance coverage. Another great thing is that they're portable. So you retain the account even if you switch employers, even if you switch healthcare plans, even if you switch a healthcare plan to a type of plan that doesn't qualify you for HSA coverage, whether that be getting on a spouse's coverage, whether that be going on to Medicare or something like that. You don't necessarily have to distribute these types of accounts. You can still maintain them, still invest them, still grow them. So you have a lot of great options when it comes to using one of these. Unlike a flex spending account or an HRA that we just discussed a few slides ago, where it's tied to your employer and it's a use or lose scenario, you have a lot of flexibility no matter what really happens in your life to be able to use these plans no matter kind of what happens to your healthcare coverage throughout your life. Now, it offers tax-free growth on investments like a Roth and traditional IRA. The contributions are tax deductible without a phase out, and it offers tax-free distributions for qualifying medical expenses like a Roth IRA. So there's a really great mixture of tax deductibility for contributions, potential tax-free distributions for medical expenses, and tax-deferred distributions for any other type of use of the money after you reach the age of 65. So again, that's one of the things I really, really like about these is kind of the marriage of all of these different benefits, specifically the deductibility of your contributions into the plan and the potential for tax-free distribution. So you really do get to kind of have your cake and eat it too with these types of plans when you are reimbursing yourself for medical expenses. HSAs supplement a high deductible healthcare plan, and that's what we really need to remember. They are designed to supplement your coverage by giving you some of the control over how you save for these expenses, and then are able to pay with tax deductible money without a taxable distribution doing that. So what are some example benefits of an HSA? So using an HSA, let's say you contribute the maximum $4,150 to an HSA. You get a deduction on your tax return. So at a 20% tax bracket, that's a tax savings of $830. You can now distribute $4,150 tax-free to pay for healthcare expenses. So think about it like this. If you had a $4,100, let's say the bill was exactly $4,150, right? Well, you could pay for that directly. Or if you made a contribution to an HSA, essentially you would be getting an $830 discount on that bill just by first making the contribution to the HSA and having the HSA pay the expense. You can do this all within a matter of days. It's not something where you have to wait to subsequent years or do anything like that. You get basically an automatic discount from making that contribution. And speaking from personal experience, I've actually done that with my own HSA. Had a bill last year when I had an allergic reaction. Got the bill from the ER, which was a lot of fun. And instead of just saying, okay, well, I'm going to pay that bill with tax with my personal money, made a contribution to my HSA, immediately paid that bill, and essentially was able to net a great discount for my tax deduction on that contribution and subsequent payment of that bill. Now, if you had no HSA involved in the same scenario, so you use $4,150 out of pocket for healthcare expenses, you would have to have almost $5,000 of earnings and pay a 20% tax bracket to end with the $4,150 that you need. So while you are having to kind of factor in what the intangible benefit of this would be, you just have to, look at it from the perspective of you have the ability to make a direct contribution to the plan and then be able to net that tax benefit. I have a question. Will I be able to replay this later so my spouse can view it? Absolutely. All these videos are hosted onto our YouTube channel, and you can grab them right there. They're typically posted within 24 hours. So again, this is a great just high-level benefit of saying, hey, look, if I have an HSA, dollar for dollar, I can get a pretty sizable discount, assuming you're in a 20% tax bracket, just on using the HSA to pay for a point of transaction expense. Where you really get to see the benefits of these things compound is when you eat that expense, you just go ahead and pay it, and then you continue to let these things accumulate earnings and continue to contribute, and then start making some tax-free distributions in subsequent years. Again, that doesn't always make financial sense for everyone. You have to look at your own financial situation individually. But when you start looking at maybe the smaller expenses that you can handle just paying, and then taking tax-free distributions once you've had the ability to contribute, deduct that from your taxes, and then also grow these things and take tax-free distributions, that's when the real power of these things really starts to become apparent. So we have two different types of HSA accounts. We have an individual HSA and we have a family HSA. Easy enough to kind of delineate. Individual HSAs are for self-only coverage, meaning that if you have a healthcare plan, even if you're married and have dependents, if those dependents or your spouse is not covered under that plan that you have, you are limited by the expenses that you can reimburse yourself for, as well as the amount of contributions that you can make to the plan per year. So basically what it looks like is that a self-only coverage plan to meet the basic criteria of an HDHP, excuse me, your self-only coverage deductible must be at least $1,600. Typically, that is going to be significantly higher. It is going to be somewhere in the neighborhood of almost the same amount as your out-of-pocket maximum. And your self-only out-of-pocket maximum for 2024 is $8,050. A family HSA, again, exactly what it kind of sounds like. If you have a healthcare plan that covers you, your dependents, possibly your spouse, again, it is a family coverage plan. Then you have, again, different deductibles and out-of-pocket maximums to look at. Your deductible must be at least $3,200, and your out-of-pocket maximum cannot exceed $16,100. Now, a few things that I kind of like to just cover with people is that when it comes to looking at your healthcare coverage, the way that it is kind of played out now is that there's less and less, at least in my summation, of a real benefit unless you have long-term chronic conditions for a lot of the more expensive deductible healthcare plans. Because once you reach your out-of-pocket maximum with a HSA, it's typically going to be 100% coverage of all medical expenses that you incur. So let's say you have some type of bad accident, you're riding your bicycle, get hit by a car. You have some type of thing that's going to generate a lot of medical bills. Well, your out-of-pocket maximums might be the same for any of these different types of healthcare plans, but instead of having an 80-20 coinsurance payment after you reach your deductible, you would just have 100% coverage with the HSA. So with those things kind of being in line with each other in general, at least what I've seen looking at the ACA marketplace and what open enrollment has kind of been putting out for my employer and also looking at my spouse's as well, the argument for using something besides an HSA, again, assuming you're healthy and don't have many ongoing medical expenses, starts to become, finer and finer. Again, it's just a matter of, do you want to be paying out of pocket basically everything up until that? Again, that's a decision for you to make. So some things that will preclude you from having a HSA qualifying plan, because a lot of people will look at it and say, oh, well, look, my plan definitely kind of meets the criteria right now, but there are some things that were written in from the Affordable Care Act that are kind of the devil in the details type of things that will preclude that from maybe being an HSA qualifying plan, because you have to have qualifying coverage. And ultimately, the best thing I can recommend people do is contact your healthcare provider to ask, is this HSA qualifying coverage? They're the best ones to do it. You can send me your healthcare declarations and I could look at it, but ultimately, the best thing, the easiest way to do it, just call and ask, say, hey, is this HSA qualifying coverage? And they'll give you a yes or no answer. So some things that would preclude it, and this is the big one, is that you can't have copays for office visits other than preventative care, your annual physical, prenatal, well child immunizations, and certain screenings. Or prescription drugs until you meet your deductible. So the no copay thing is something that gets kind of stuck into certain plans that would preclude it from being able to be covered by an HSA account. So keep that in mind. Again, the best thing you can do is just call, ask, and then get it. And we'll go over a few of the other precluding issues as well. So again, the self-only coverage deductible must be at least $1,600 for single. For 2024, family family coverage deductible must be at least $3,200. Out-of-pocket maximums are going to be $8,050 for self-only coverage, and family coverage is $16,100. Again, that's the high level of the first point. The second point is you cannot have any other healthcare coverage. You can have vision, dental, workers' comp, long-term disability, long-term or disability insurance. You also cannot be enrolled in Medicare. So especially for some of my aging clients, once you get to your qualifications for Medicare, if you want to have an HSA, well, you may no longer be able to contribute to that HSA if you switch over to Medicare. So that's definitely something to consider, depending on what your investment goals and your expenses look like. Opting into Medicare at a certain age may or may not be beneficial if you're really very strongly engaged with an HSA. Let's see, good question just popped up. If I'm under my spouse's HDHP, I have an HSA account with Advanta or need to have an account with the same custodian as my spouse. So that's a really good question. So basically, you do not need to have the HSA in the same location. Your employer can certainly be contributing to it at one location, and you can elect to custodize those funds really wherever you would like to. So you can have an HSA potentially in multiple places. So, I mean, even for me as an example, my HSA plan through Advanta, we have a certain bank that offers the HSA where the payroll deferrals are going to. And then I also have a self-directed HSA here at Advanta that I roll funds between if I want to make an investment or utilize those funds in a more alternative manner. So again, you don't necessarily have to have it as the same custodian as the spouse, but keep in mind your contribution limits are your contribution limits. So you can't contribute up and over what the allowable contribution limits are for a given year, even if you have an HSA at multiple different locations. So again, great question. Yeah, absolutely. And you also cannot be claimed as someone else's dependent. So even if you have an HSA qualifying plan, you have the HDHP coverage in place, if you are claimed as a dependent for someone else, you cannot utilize an HSA account. Now that really doesn't come into play too much. I suppose there probably are some people that are in their early 20s that maybe are, or mid 20s that are still, claimed as a dependent, but maybe have their own healthcare coverage. Again, can be claimed as a dependent on that. So unfortunately, you couldn't set up like an HSA for your children, if you will. You can set up things like Roth IRAs for your kids if you're paying them for working at maybe a family business. Even if they're covered under a family HSA, you couldn't start one for them really early if they're claimed as a dependent. Again, that one doesn't come up too much, but especially with the people that are typically engaging with Advanta, it might. So it's definitely good information to know. So some more fun rules that you may or may not have heard of. It's the first day of the last month rule, and it's why we do this presentation around this time of year. So with open enrollment coming up, you have the ability to change your healthcare, right? If you would like to get from one type of plan to an HSA qualifying plan, whether that be through the Affordable Care Marketplace or through an employer that's offering open enrollment, in order to qualify your contributions for an entire year, you have to have the coverage bound by the first day of the last month of the year, meaning that you have to have your coverage in place by 12/1 in order to make a contribution for the year of 2024 in this example. So if you, let's say, bound your coverage and it didn't come into effect till January 1, you couldn't make, or let's say it came into effect December 15th, right? Well, that coverage wasn't in place by that first day of the last month rule. So if the coverage is not in existence by 12/1, you don't have to have the HSA established, like the account established, but you have to have the coverage bound by 12/1 in order to be able to make a contribution for this year. So you have up until your tax filing deadline, so the timely filing deadline to make a previous year contribution and even establish an HSA for making a previous year contribution. But if that coverage wasn't bound and in effect 12/1, you can't make a contribution for 2024. If the coverage was bound on 12/2, can't make a contribution for 2024. It has to be 12/1 first day last month. So if you see that out there, if you're doing some more research and you see the first day of the last month rule, that is what that is talking about. So an example would be Ben enrolls in an HDHP on 11/30/2024. He can contribute the full $4,150 to his HSA account for 2024 and take the deduction on his taxes for 24. If Ben were to lose that high deductible health plan care coverage prior to 11/30/25, he has to take a prorated distribution from the HSA account. So the distribution is then subject to taxes and a 10% penalty. Meaning that, let's say, you had coverage for 8 months out of this year and you changed jobs, changed healthcare. Well, in that first year, if you didn't maintain coverage for the full rolling 12 months from the first day of the last month of the previous year, you would then have to take a prorated distribution of basically 4 months. So you would take $4,150, divide by 12, then multiply by 4, and take that as a distribution from the plan. So you attribute the contribution as evenly spread between all 12 months and take the prorated distribution according to how many months of the following year you did not have coverage. Now, I know this sounds complicated, and it is. It's definitely kind of a very nuanced aspect of healthcare savings, and especially HSAs, that really doesn't have any corollary anywhere else with regard to other accounts that you might have. But after the first year, you don't have to worry about it. So let's say you maintain coverage until 11/30 of the next year. So from 12/1 of 24 to 12/1 of 25, you had the HSA qualifying coverage. Great, you change coverage after that. You don't have to worry about anything. You don't have to worry about taking prorated distributions or anything funky like that. It's all good to go from there. But the first year, you are under some restrictions with that first day of the last month rule. And it's definitely something to be cognizant of, especially with how often people change jobs, maybe wanting to change healthcare, especially if in the following year you wanted to maybe change plans. The HSA qualifying healthcare coverage didn't make as much sense as you thought it did. Just make sure that you are abiding by the full 365 days between coverage changes if you did make a previous year contribution to an HSA. So contributions, how do you put money into these things? Contributions must be made in cash. Can't do it in kind. Meaning you can't take an asset such as a piece of property, if you have one in an IRA. You can't take gold coins. You can't take crypto. It has to be made in US dollar cash to the plan. You can do a one-time rollover from a traditional or Roth IRA to an HSA, but they are going to be subject to the contribution limits of the HSA for that given year, and you cannot use SEP or simple funds for this. Contributions can be made by employee or employers on behalf of the employee, but if the employer makes the contribution, it is not tax deductible to you. Employee contributions are tax deductible. So if it is an employer offered plan and they offer an additional benefit of making a contribution on your behalf, that is the company that is going to be capturing that tax deduction for the contribution to your HSA. If you make the contribution to the HSA, you get to claim that deduction. It would be really nice, but again, it's not made as part of your payroll deduction. Now, potentially there are some employers that would offer the ability for you to do a payroll deduction contribution to the plan, in which case that would be your money and would be tax deductible. But make sure you look at it, just kind of ask the question and make sure you're looking at your pay stub to say, okay, where is this money coming from? It's being netted out of my paycheck, to make sure that you can match up your tax forms in the beginning of the following year to make sure you are claiming the correct deduction for any contributions. And for most people, they make separate contributions directly to the HSA. You'll get your tax disclosure form for that separately. But again, important to remember, depending on whom is making that contribution, as to who then in turn can claim that as a deductible item on your taxes. And you can take deductions for this even if you don't itemize. That's another important thing. So this is not a type of plan where you have to be an itemized filer. And for most people, especially with the tax bracket updates under the Secure Act, the itemization of a tax return has become much less common for most taxpayers. But again, it's important to understand, even if you don't itemize, you can still claim the full deduction for this under the standard deduction for filing. Contribution limits. So for HSAs for self-only coverage, you can contribute up to $4,150 this year. Next year, it's going to go up to $4,300 for individual self-coverage. HSA family plans can contribute up to $8,300 or $8,300 this year and $8,550 for 2025. If you're over the age of 55, you get an additional $1,000 catch-up contribution to either. So it'd either be $5,150 or $9,300 if you're over the age of 55 with a qualifying healthcare plan and an HSA. Okay, good question. Can you roll over a 401k from a former employer into a new HSA at your new employer? Potentially yes, but you would have to first roll those funds to an IRA and then into the HSA. It's kind of a little bit of a two-step, but you could potentially do that. The problem is that, well, I guess you said it's a former employer. So yeah, if you have the funds in the former employer plan, it just comes to the IRA first and then into the HSA. Again, keep in mind is that you don't get to claim an additional deduction for that, and it's only up to the applicable contribution limits of $4,150 or $8,300 for this year. Again, depending on your age, you might have a float of $1,000 either way on both of those. But a lot of this is a great deduction option. And again, everyone's personal finances are different. I'm not saying you shouldn't do that because it's a bad deal and it's awful. But again, just keep in mind is that when it comes to something that is straight, there's no scaling deduction phase out for this, the deductions that you can get from this are pretty awesome. So yes, can you do it? Absolutely. I don't see a whole lot of people doing that, but in that example, absolutely, you can definitely roll over those funds to an IRA and then into the HSA if you no longer work for that employer. Now, the distributions from these types of plans have to be for qualifying medical expenses. These are just some of them that are listed up here. If you would like to see them in more detail, and the IRS lists them out in painful detail in publication 502, they're in alphabetical order, and you can just go down and see what is a qualifying medical expense. But in general, your healthcare plan deductible is a qualifying medical expense. Cost of a doctor's visit, dental care, office visits, x-rays, cleanings, fillings, braces, vision care, exams, glasses, contacts, surgery, medications, prescriptions, prescribed OTC meds. So if you have a prescription for, let's say, ibuprofen, that's a pretty common one. You have a prescription for Claritin, or maybe something for indigestion, like Prilosec. If you have a prescription for those, you can use HSA funds for buying them OTC, but it has to be prescribed. It can't just be like, oh, well, this could be a prescription medication, I'm going to use my HSA funds for it. Have to have a valid prescription to use that as a reimbursement amount. Is the 401k to IRA to HSA rollover the amount limited to the HSA contribution limit? Yes. So if you're going to use a retirement plan, such as an IRA, a Roth IRA, a former employer plan, to make a contribution to an HSA, you are bound by the contribution limits of the HSA. So if you had, let's say, $100,000 in a former employer plan or an IRA or a Roth, you couldn't just dump the 100K into the HSA. You're going to be limited by the 4150 individual contribution plan limit or the $8,300 family plan limit for that contribution amount. Bandages, other OTC first aid kits, chiropractors, capital improvements to a home with the purposes of medical care. So think wheelchair ramps, lowering sinks for people that might need something lowering countertops, new phones for vision impaired people. Again, you can use HSA funds for a lot of different things. You can also use it for lodging and trip expenses for medical care. So if you are getting surgery somewhere, let's say the procedure is not offered locally to you and you have to travel to somewhere in the country, you can, if you're just going on that trip for the purpose of that medical procedure, you can use it to pay for your plane tickets, your lodging, your food, all that kind of stuff related to that medical event. Also, psychiatric, psychology, and long-term care are also included in allowable expenses. So what are non-qualifying medical expense? Plan premiums except for COBRA. non-prescription drugs, weight loss programs, if it's purely cosmetic. So if you have some type of medically required bariatric procedure, that's a portion of a diagnosed disease, yes, you can use HSA funds for that. Cosmetic surgery, teeth whitening, nutrition supplements, cosmetic hygiene, babysitting, healthcare clubs. And the big one is medical expenses reimbursed by FSA or medical savings accounts. You cannot use your HSA funds to double reimburse yourself. And you also cannot pay for future medical expenses. So if you get a bill for something, you have to undergo the procedure or the service before you can reimburse yourself. And that one is probably one that's going to come up a little bit more for people. You may very well get a preliminary bill for a procedure. Until you have that surgery or that procedure or that service has been rendered, you can't go ahead and repay yourself for it. Again, you can use it as a point of payment after service is rendered. A lot of times, Advanta doesn't offer this, but in more traditional HSA type accounts, you would get something like a debit card to use. I know I personally have one for my portion of my HSA funds that I don't self-direct. And yeah, I can go to my doctor's office, have my checkup, swipe my card and pay right then, but I couldn't prepay, if that makes sense. Now, you are under no obligation to repay yourself at point of transaction for these medical expenses. You can repay yourself in perpetuity. So if you have a medical expense, and we do a pretty cool example of this here in a moment, you can reimburse yourself 20 years later after you have compounded and grown and had plenty of tax deferred earnings on these funds. You can then potentially take a distribution to reimburse yourself, so long as it was under the not covered by another medical plan anytime in the future. And that goes for, let's say you had HSA qualifying coverage for 5 years, and then for the next 15 you didn't, but you had plenty of medical expenses in those 5 years. Well, you can continue to grow those funds, grow, invest, do your thing with that account, and then 20 years later take a reimbursement and pay no taxes on that reimbursement from those medical expenses incurred almost 20 years ago. But ultimately, the IRS deems that you are responsible for maintaining records of those expenses. If they audit, they ask, you have to prove it. So keep your receipts if you're going to be using an HSA. Make sure you're record keeping those. Make sure you're using those record keeping those correctly, because otherwise you might get hit with a 20% improper distribution penalty plus income tax owed on that. So it's definitely not something that you want to do. And also keep in mind that medical expenses that have been itemized for a deduction cannot be reimbursed. So while you don't have to be itemizing your tax return to take a deduction for your contributions, if you have claimed the medical expenses as an itemized deduction on your tax return, you cannot use HSA funds to reimburse yourself for those expenses. Distributions from HSAs. You can take a tax-free distribution again anytime after the expenses occurred. HSA distributions are tax-free regardless of age or how long the plan has been in existence, as long as these requirements are met. Distributions for a qualified medical expense, and the expense is incurred after the HSA is established. So those are the two things that have to be met, that no one else has reimbursed you, whether it be the government in the form of a tax deduction or another insurance provider, and that it's the reimbursement is occurred after the HSA is established. So here's kind of a breakdown of how this might actually work in practical terms. So 2024, Joe opens a self-only HSA and makes a $4,150 deductible contribution. Joe has a grand of qualifying medical expenses from May through December of missed that one, should be 2024, sorry, missed a date. I used this example a lot. Through December of 2025. At the end of that year, he takes a $1,000 distribution from the HSA tax-free. The remaining $3,150 plus any account earnings remains in the HSA for future expenses. Following year, Joe makes another $4,150 deductible contribution to the HSA. In March 2025, Joe has surgery costing him $3,000 out of pocket. He takes an immediate distribution in March to pay for the expenses, leaving $4,300 in the HSA. He also accumulated another $500 of expenses in 2025. In 2026, At the start of 26, Joe has 4,300 plus earnings in the HSA. He accumulates another $500 of qualifying medical expenses, but doesn't take a distribution. In January, he made a 4,100 deductible contribution. During 2026, he accumulates another $1,000 of qualified medical expenses, but takes no distributions. So you see, in this example, Joe is making contributions. He's reimbursing himself from some. He's not reimbursing from others. And then in 2027, he now has $8,450 plus earnings in the HSA and about another $1,500 of expenses. Joe makes another annual contribution and accumulates $1,000 or so in expenses. He takes no distribution from his HSA in 2027. Fast forward 10 years. At the beginning of 2037, Joe has about 80 grand in the HSA. Contributions, earnings for the last 12 years. He has $20,000 of qualified medical expenses over that 10-year span, but he took no distributions. So in 2037, he can write himself a check for 20 grand tax-free from the HSA, which is really the amazing part of this. If you just kind of have nickel and dime and some small expenses here and there that aren't going to, particularly change your financial situation, that you're okay with just paying the expense, you can continue to leave these funds in there to grow. And that's the important part, is the growth of these funds through investment that can then generate a lot more money in the account than you otherwise would have had in expenses to be able to take tax-free reimbursements. And then let's say in 2040, he wants to remove some of the funds from the HSA, but he doesn't have any qualified medical expenses. So what are the options, right? The idea is that you're going to have well and above what your accumulated expenses are in the account. But if you don't have qualified medical expenses, what do you do? So if Joe's under 65, the distributions from the HSA will be subject to income tax and a 20% penalty. Again, the IRS doesn't want you taking money out of this unless you meet some criteria. If Joe's over 65 or he's become disabled, the 20% VIG to the IRS does not apply, but the distributions are subject to income tax. So that's where the hybridization of this account being like a Roth medical account and a traditional IRA come into play. So once you reach the age of 65, you can treat this as a traditional IRA and just pay taxes on the distributions. So just like you took a deduction for a traditional IRA contribution, you just pay taxes on the way out for anything that's non-medically related. It's a medical related reimbursement. It's tax-free distributions of your capital from that plan. Very cool aspect of the HSA is one that I wholeheartedly tell people, look really strongly at these plans, because the benefits for the investment returns and the distribution rules are pretty amazing. Good question. So does the $20,000 that Joe took as a tax-free distribution need to be for medical related expenses at the year 2037? Well, they have to be related to medical expenses, but they could be from the last 12 years in that example. So it doesn't have to be 20 grand of expenses in that year. Again, you have to record keep your receipts, but if you can just pay the expenses, you can reimburse yourself 2 years later, 3, 4, 5 years later, 20 years later, so long as that you haven't itemized that as a deduction on your tax return and it hasn't been covered by any other medical expense. To my personal example, I paid that hospital bill with my HSA funds as a tax-free distribution in July of this year. I went to the hospital in like May of last year. So you don't have to make the distributions in the same year that services were rendered or the expense was incurred. But absolutely great question. Naming a beneficiary of your HSA. So beneficiary rules for HSAs are what kind of lead a little bit more towards planning with these types of accounts, insofar as that you might want to look at trying to deplete them before passing on, especially if you don't have a spousal beneficiary. So if you name a spouse as a beneficiary of an HSA, the spouse can treat the HSA as their own, right? So you predecease your spouse, the spouse can take it. Now, if your spouse predeceases you, meaning they died before you did, any non-spousal beneficiary, the HSA ceases to be an HSA account, and the value is taxable to your beneficiary in the year you die. If your estate is the beneficiary, the HSA is included in your final income tax return. So if for estate planning purposes, and especially if your spouse you had reimbursed yourself for all your medical expenses, your spouse maybe was not covered by qualifying HDHP coverage, you're over 65, again, for planning purposes, get with an estate planning firm, but there might be some benefit towards trying to make sure that these things are depleted, or you take your medical reimbursements once you get on Medicare, before you maybe have an end of life event. So definitely some interesting caveats with regard to end of life with HSAs. Now, how can you invest these HSAs? Well, certainly there are banks you can stick it in, kind of a 0% interest kind of checking account, just hold the cash balance, but then you're just fighting inflation. What we really love to see with people is that go out and invest these funds in assets that they know and understand. We have clients that own rental properties in their HSAs, that are invested in multifamily syndications, that lend people money, that buy private stock, that own precious metals in their HSAs. So the options are very, very wide, and there's definitely going to be something out there that suits your needs. HSAs cannot be invested in the following: life insurance or collectibles, so antiques, alcohol, artwork, stamps, coins, with the exception of bullion content traded coins. Those are the things that you can't invest in. You also can't invest with certain disqualified people. You can't lend money, buy something, or otherwise benefit with the HSA funds while they're in the HSA yourself or your spouse, lineal descendants or ascendants of you personally, so mother, father, son, daughter, spouse. Those people can't directly be transacted with or invested with, or businesses or entities owned or controlled by a disqualified person. So those are again kind of the high level rules with whom you can and can't invest with. Now, from a practical standpoint, what's an example of actually investing? So investing in HSA and real estate. Heather wants to invest in real estate deals with other people who buy and flex properties, right? She has about 20 grand in an HSA that's currently invested in mutual funds. And she thinks she'd do better, get better returns by lending money on some type of note to someone, and doesn't want to be involved with the day-to-day hassles of owning the property. She doesn't want to be involved with tenants, toilets, and termites, right? The 3 T's of owning property. So she meets Steve. He's looking for an investment partner and has acquired a property for rehab. Steve needs 20 grand for rehab costs to then sell. Heather, in this case, offers to lend Steve 20 grand from her HSA and split the profit when the property sells. So what's this look like? So the loan amount's 20 grand. The participation of profits is 25%, and it's secured by a first mortgage on the property. The total profits from the sale are 30 grand. Tax-free back to Heather's HSA as far as the profits go is $7,500. So now Heather, after this property matriculates and gets sold, she now has $27,500 in her HSA that she can either use for qualified medical expenses. If she's over 65, she can take a taxable distribution, or she can continue to rinse, wash, and repeat and continue to grow through additional investments for potentially taking tax-free distributions in the future. So that's pretty much what I have for everyone today. I do encourage you, if you would like to learn more, we have these great events twice a week. We catalog all of these on our video library. I also personally host our podcast here at Advanta, the Alternative Investing Advantage podcast, hosted every Wednesday. And we also have an open investor pitch call, our Pitch, Promote, and Prosper. That's the last Friday of every month. So we just had one last Friday. I'd encourage you, engage with us. Let us help educate you on this stuff. We really do our best to try to demystify some of the more complicated aspects of retirement plan choice, especially with the HSAs and other things like that. And if you do have any direct questions, I encourage you reach out to me directly. Again, my name's Alex. My direct contact information is right up there. See a few questions pop up. So we have a question: can I use my self-directed IRA plus an HSA together to invest in real estate? Absolutely. You can definitely partner your accounts on a new deal. There are some kind of specific guidelines for that, which we have done several webinars on partnering plans together. Basically, it has to be new partners on a deal. You can't have a deal already done in your IRA and then sell a portion to your HSA. It has to be newly acquired, same side of the closing table, partners from the onset, that you would do something like that with. So again, with that said, if there are any other questions, I'll stick around for a few more minutes. If you'd like a copy of the slides, they are attached as a handout, so do grab those from there. But other than that, I want to thank everyone for joining with us. I hope you have a fantastic Halloween and towards the end of the year, everyone has great and safe travels through the holidays if you are traveling. And if we can help you with anything towards the end of the year with HSAs, IRAs, 401ks, all of those kind of things, please do reach out to us. We are always more than happy to help. So thanks for joining.